What's an emerging risk that you think most investors are still underpricing?
As much as I believe in the whole artificial intelligence movement and kind of what's going on there, and I think there are some huge winners and will continue to be huge winners, I still have doubts about the quality of the data in the databases. And so I think there's a risk that there's a lot that can get done with these, large language models and with these databases, but I feel that there's always a risk that there's a lot of crap in databases that, could push people to make decisions that aren't the correct one.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Eric Silverman on the program. He's the managing partner at Eastham Capital. Eric is a seasoned investor with a deep track record in real estate, having led 6 successful funds. That's impressive. He's now raising a 7th fund. He has decades of experience spanning real estate, banking, early stage investing. He brings a rare mix of operational depth, strategic clarity. He's also served in key roles at institutions like Leader Bank, RentGrow, and has a sharp eye for distressed multifamily opportunities. We're excited to dive into his insights on investing and markets and what's next for real estate in the private capital world. Thanks for coming on, Eric.
Great to be here, Brian. Thanks so much.
So would love to get kind of the origin story of how you found your way into real estate.
Okay, sure. So I pretty much grew up in the business. I grew up in Detroit. My father was a developer. So I've always been around the apartment industry. But I got the hell out of Detroit after high school, went off to college and kind of did my own thing. But kind of always kept kind of some roots to multifamily real estate. And in the mid 90s, 30 plus years ago, I started investing with my current partners, buying typically suburban garden style apartment properties, mostly in upstate New York. A little bit, I was living in Boston. They were in Boston as well, but we were buying more in upstate New York. And I was a limited partner and I was, trying to be helpful and an investor. And I brought some other investors along with me to these, opportunities that my partners were putting together. And then my partner, Matt Rosenthal, this is now about 20 years ago, came to me and said, we'd like to expand geographically. We'd like to invest in more places. And we don't want to do it by building a management company that goes across the country. We feel that management is a local business. And what we'd like to do instead is find great operators across the country and build a business that way. So that's really the origin story, if you will, of Eastham Capital, where we came from. We took it from there. And then we did our first fund back in 2007. We launched the fund and the rest is history.
Yeah, that's incredible. What a time to raise a fund. I mean, if your thesis is distressed multifamily, 2007 was like almost perfect timing for Fund 1. Maybe you could talk a little bit about that.
Yeah, the truth is the good news is that we raised the fund and '07 was the tail end of kind of the top of that market, kind of '04, '05, '06, '07. Real estate prices were going crazy. Certainly single family homes, but also multifamily was getting very pricey. And then things started changing very dramatically in the financial markets towards through '07 and into '08. And I guess the best news is we raised the fund in '07. We didn't buy anything. So we waited until 2008 to start buying when we started seeing some real distress. And then, of course, the timing was good and we bought in '08, '09, and '10, et cetera.
Oh, so maybe we could talk about some mechanics of Fund 1, how big it was, what was the deployment period, performance, all those things that LPs kind of care about.
Sure. So small fund, everybody told us, just get out there, get a fund done, get in the market. And at that point, the number now today, it might be a higher number, but at that point it was 10 million. So go put together a $10 million fund, start executing. And my partners and I put about 2 million of the capital in. We raised the other 8 from about 40, 45, mostly friends and family to some degree. And we started buying properties. And so that's kind of the size. That fund turned out well. We bought '08, 9, and 10. Sale
we didn't make our first sale until 2013,
so,
I believe.
we were holding properties for 5 years. Those properties did very well.
Those properties did
net
very
result
well.
of that fund was
net
it was a
result of that
2.2x
fund was it was a
fund
2.2x
with a
fund
IRR
with a
neighborhood of
IRR
about 18 or 19.
neighborhood of about 18 or 19.
There's a couple things I wanted to tease out there and kind of highlight. One is the big GP commit. I mean, you guys committed 20% of the fund, which is sounds high. I would imagine you're not still doing 20% in Fund 6 and 7.
Well, we're not doing 20, but we did actually a little north of 10% in Fund 6. So
Wow.
the partners, we put in a little over $40 million into Fund 6 on a $400 million fund. And so as now we project out into Fund 7, we've committed that we'll put at least 5% into this fund. And I think it could grow and be closer to 8 to 10%. So our goal is this is where we're putting our money. The vast majority of our money is going into our funds.
Yeah, and I think that LPs like that. Maybe you could comment on, in real estate. I know how it is in venture capital as an emerging manager. A lot of emerging managers put 1 or 2% unless they had some big windfall in the past. They exited a startup or something like that. But I can see myself increasing that amount over time as my funds do well.
Yeah, well, it's one of our investment rules is we want to see skin in the game. So when we buy apartment property, we go to partners that can put significant skin in the game. That's a critical component of our decision-making process. And so we just wanted to do that as well in our own fund. And I do think investors like it and respect that, this is where we're putting our significant amount of our capital. And
maybe you could talk about the structure, because you did a limited partner structure, which is much more typical on the startup side, private equity side of things versus like a REIT structure. Maybe you could talk about kind of that decision-making process. What drove the kind of the more the limited partner?
A REIT structure is actually more complicated than a limited partner structure. And the key benefit that you get from real estate, and you get it from either doing it through a REIT or alternatively doing it as a limited partnership with the right structure, is that we pass through the depreciation that we create. So by passing through that depreciation through the K1, we're able to create a lot of losses. They're non-cash losses. They're, accounting losses, especially in the early years of the fund. So we get kind of the same benefit that you would get from creating a REIT, but with less complexity. The other thing, just while we're on that topic, is that early on we found a unique structure. Typical limited partnership structure for accredited investors is called a 3C1. And typically you can have up to 100 investors in that structure, although some of that has changed with the Jobs Act. Another structure that's more common in the limited partnership world is a 3C7, which is for qualified purchasers. So people not at the $1 million net worth level, but at $5 million or more of investable capital. And that, that's prohibitive to raising, capital from a lot of people. But we found another structure called a 3C5, which is control real estate only. So as long as we owned a majority of the properties that we're investing in and control kind of what happens with them, we're able to take accredited investors. And I believe when we first did it, I think we could take up to 500. Now I think it's up to 2,000 through this 3C5 structure.
Oh, that's nice.
I mean, I guess if you're into talking about cool things about limited partnership structures, 3C5 sounds really cool. It might not be very cool in other conversations, but it's pretty cool for limited partnerships.
Yeah. How has the strategy evolved over the years? I mean, you're now almost 20 years into running these funds.
Yeah.
What have you learned? And what are some of the takeaways?
Well, we really we work hard to stay in our lane. We typically buy suburban garden style apartment properties, garden style meaning typically there's multiple buildings on a campus. Each building might have anywhere from, say, 8 to 15 or 20 units. And then there's multiple buildings that kind of all add up to 200 to 300 units. Typically, some are a little bigger or smaller, but that's our typical property that we buy. We've stayed, there was a huge building boom in America in the 70s and 80s. The majority of the product that was built was that suburban garden style property. Then things waned in the 90s and 2000s. Even 2010. So for a number of years, that's come back quite strong over the last 5 or 8 years. where there's been more new development and more suburban garden style development, but for a long time there wasn't. And so a lot of the properties we buy are as old as those 70s and 80s properties that need renovation work, as well as some of the newer properties, because once a property is, more than 15 or 20 years old, there's significant amounts of renovation work that need to go in.
So you mentioned identifying the right managers, developer partners. Maybe talk a little bit about that strategy. It almost sounds like a fund-to-fund strategy in a way, or are you talking about kind of the property management team on the ground there managing the property?
It's not really fund of funds because we're not buying into funds. We're buying into individual deals. But the structure is that our joint venture partners come to us with a proposed deal. And I should say our partners as well as potential partners come to us. I was just talking to give you a sense of kind of our deal flow in terms of properties that we see every quarter. This quarter will be our biggest quarter in our history. We're over 300. We've reviewed over 300 potential investments this quarter. We'll close on 2 or 3 of them. So it's a very big funnel. But, we get the deals or the opportunities not from typically real estate brokers, but typically from operating partners looking for capital for their deals. So there is, part of the structure is that we do, because we decided not to build a management company, we do look for operators that are really good operators. That's a really critical component of our kind of investment rules. And we spend a lot of our time, and I've got 3 analysts, and they spend most of their time talking to either existing partners or new potential partners.
Yeah, that makes sense. And you mentioned the performance, a little over 2x, a little under 20% IRR, which is great. I think that implies something like a 5-year fund life, 5 to 7 year fund life. Maybe you could talk about how you manage the fund life and the duration of each fund.
Our fund lives are actually closer to 10 years because, remember, we're not buying all at once. So it's not a fund where we're pushing all the money in the first 6 months or a year. We're buying over a 4-year investment period. And so it actually is kind of there's, I guess, a J curve where we're putting money out, but then we start getting money back through cash flow. And then eventually probably by year 4 or 5, we start selling properties. And then it probably takes us most of the time to get, 9 or 10 years to sell off all the properties. I can tell you of the first 4 funds that are fully round tripped, we were able to complete all the sales, renovations, and purchases, renovations, and sales within that 10-year time frame.
So you're basically buying these distressed garden style communities, repositioning them, stabilizing them, increasing the cash flows. And then you find another investor 5 to 10 years later who's like, okay, yeah, now I'll buy this and kind of just cash flow on what you've stabilized. And that's your exit.
We like to think that most of the properties let me back up. All of the properties that we buy have some renovation budget. And so some value add, some kind of combination of fix the problems and add value through improvements to the property. Improvements both in the physical nature of the property, the landscaping, the drive-by of the property, signage, et cetera. And then then we effectively go unit by unit renovating units. We don't typically renovate all of the units of the property, but it still takes us at least 2 or 3 years to kind of go through the renovation programs that we put in place.
Yeah, that makes sense. So you're looking at hundreds and hundreds of these potential investments. What are you kind of seeing out there in the market today that others might be overlooking?
We're having significant deal flow. Transaction volume in our space over the last 2 to 3 years. So there's the interest rate spike between 21 and 22. And that really slowed down transaction volume in 23, 24, and even this year. Transaction volume, we thought at the beginning of the year it will come back stronger. What we're seeing now is we're seeing deals in the market, but not a lot of them are getting completed. So some of them are. There's certainly transactions happening, but not to the levels that we were seeing in 2020, 21, and 22. Well, post-COVID, right immediately post-COVID, and then 21 and 22.
Yeah, and it seems to kind of go in that 7 to 10 year cycle in real estate, right? Where rates go down, and then rates go up, and you were kind of in an upcycle right now. What are you kind of seeing out there, and how that's sort of affecting your confidence level and how you're
Yeah,
underwriting deals? I mean,
I do
certainly if you
think,
bought and locked in some low rates, you're in a really good spot now.
and for the people that locked in rates, the low rates, typically the typical multifamily real estate loan is kind of 7 or 10 year loan. You can go a little longer, a little shorter, but those loans are actually coming due. And a lot of those loans that were written at 3.5, and 4% are coming due, and the market is now more like 5.5 or 6%. So it's a little, pricing has come down. I would argue that we've probably seen the bottom over the last couple of years, and we are starting to see prices improve. But it is interest rate dependent, and if we get another spike up in rates, that could actually soften the market again. If we get the interest rates trending down a bit, then we'll see this continuation of pricing getting a little better.
Right. And if your thesis is, distressed, it would seem that you kind of you want to expand that duration of your funds to that 4 or 5 years that you mentioned. That way you can time the market right a little bit. And then it would seem, I would theorize that you would have more distressed real estate after an interest rate run up, right? Because some property owners get caught holding the bag a little
Sure.
bit, and they
Yeah.
lose their cash flow and they can't maintain their properties. And that's where you get into trouble.
Well, we're kind of right there now.
Yeah.
So a lot of the deals that come to market have some level of financial distress or ownership distress. But I think that's going to take a few years to play out. So I wouldn't say we're timing the market per se. We're just trying to stay in the market and be there to provide capital to our partners, both existing and potentially new partners, so that when they find a deal that makes sense, we can jump on it.
Yeah, and so you mentioned the wave of maturities happening coming, a year or two. Do you view that as an opportunity or a risk?
Well, it's definitely an opportunity for Fund VII, for the new fund that we're creating. Probably more of an opportunity than a risk. For my current funds where we're selling properties, Funds V and VI, it's a little more of a risk because, can we get out of those, investments at good pricing? But we generate that better pricing, not just due to stress in the market. We generate it by taking a property that is not performing to its top level. It's not as stable as it should be. And we bring stability into the cash flows and the operations of those properties. So all things equal, we should be able to sell them at lower cap rates, better prices.
Yeah, so you add a layer of complexity here that we don't typically have in VC. How do you maintain the alignment across the LPs, GPs, and operators, especially in these kind of tough deals?
Well, I would say skin in the game is probably an important component of alignment. So we're all investors. We're all, taking risk, if you will. We diversify the risk for our existing investors because it's diversified over time. It's diversified over partners, locations, because we've invested in 23 states and we're active in multiple parts of the country. It's diversified, over to some degree property type, but like I said, the vast majority is suburban garden style apartments, but that as well is the vast majority of what's available out there to buy. I think that, at a high level, we spend a lot of time trying to de-risk the investments by being very picky on what we buy. They say you can change the loan, you can change the operations, but you can't change your entry.
You make money when you buy real estate, not when you sell. Is I think the old phrase, right?
That's what they say, and that's true. And what's really true is you've got to make the right buys.
Yeah, that makes sense. So let's talk a little bit about your broader investment experience. You had an exit from RentGrow. How does that inform how you invest today?
Oh, that's interesting. RentGrow was a company that I ran for a period of time. Then I was chairman for many years. We sold that to Yardi. People in the real estate business are probably familiar with Yardi. RentGrow was a background check business. Yardi made I think, wise decision purchasing RentGrow. They were looking at some much smaller background check companies at that time. We sold in 2010. They chose to buy us, not that we were that large. I think our revenue was $8 million at that time. My guess is Yardi maybe they've 10x that revenue. They've certainly, they're probably doing at least 50 million. Maybe they're doing 80 million of revenue through that business 15 years later. And, what I learned from that, and I think I carry that through to other investing, including Eastham Capital, is that I try to look out take an investment that we own, whether it's Eastham or some other investment, look out a couple years and say, can I sell this now at a price that I think would be hard to do better than 2 years out from now? So if I can de-risk the next 2 years by taking a profit now, let's be a seller, not hold on. And for very high growth companies, that's a tricky equation to make. So I would say for a lot of the early stage venture companies, it's hard to project out 2 years unless you make some assumptions that we're going to have 50 and 100 and 200% growth. And then obviously you can believe that the pricing is going to be a lot higher. In real estate and in some of these, RentGrow at that point when we sold was almost 20 years old, believe it or not. It started back in 91. For a company like that was growing moderately, maybe 15, 20, 25% a year. So not bad, but, not a rocket shot. It was easier to make the estimation of what do I think the value of this business will be a couple years out, and can I capture the majority of that value today?
Good insights there. So you sat on boards in banking, prop tech, construction. How do you synthesize the cross-sector insights?
Probably the board that I've learned the most from sitting on has been Leader Bank. It's a bank that is based outside of Boston in Arlington, Mass. We started it in 2002. We launched, so it's 23 years old. I've been on the board since, even prior to it, we launched the bank. Banking is, seen as kind of a dull, boring, old school business, but actually, given what's gone on with fintech and, all sorts of other, interesting things with finance over the last 20, 25 years, it's been exciting to be part of that. And so I've learned a lot from sitting on that board, and hopefully I bring that back to the other companies that I'm involved with and Eastham.
So back to the early stage mid-market operators, what are some of the biggest mistakes you see them making?
For the partners that we invest with? Yeah. So I would say over the years, we've found a lot of operating partners out there. I would say that only a few of them are really passionate, great operating partners. There's a lot of groups that are good at financing. They're good at maybe to some degree finding deals. They're good at, they're good at different things, but finding groups that are really passionate about property management, which is a difficult business, is hard work. So to give you, and by the numbers, in the years that we've run Eastham, we've interviewed over 2,000 potential operating partners, and we've invested with 18. So we're very picky on who we work with. So a lot of the mistakes that I've seen made are sometimes growing too fast. Sometimes they're mostly people problems or people issues, not having the right people in place.
So you've had an amazing career. What keeps you motivated?
Well, I kind of love, having grown up in the apartment industry and kind of, being a part of it. I'm interested in just kind of how it all evolves over time. For the typical property, what we don't play a lot in is high-end newer properties. So Class A, new construction properties. But one of the things I learned a long time ago is if you want to create a B-class property or potentially C-class property, you've got to, build a property, but then you just got to wait 25 or 30 years. So it's a business with a very long time horizon, and we just have to kind of wait and see where it goes. I'm interested and excited about some of the new product types that are coming out. They're not for us yet, but I've been talking to people about the build to rent space. So the first thing that kind of came out of the financial crisis was buying homes and renting homes. And those homes were not built, those homes were built scattered, they're scattered site, they're built at different times, they have different systems. I never liked that business. There's a few companies in that business that have done well, to be sure. But then probably in the mid-teens, you started seeing this build to rent, where they would build homes or townhomes and build 50 or 100 or 200 units. They all have the same systems, the same structure. They're built all at the same time. What I'm looking forward to is 5 and 10 and 15 years in the future, when some of those don't perform as well, and maybe there's an opportunity to buy in and fix the problems.
It's one thing about you most people in the industry wouldn't guess.
Well, some people know this, but not a lot. I like to memorize numbers. And so many
How many
years
digits
ago,
of pi do you know?
so that's exactly, I don't think we had this conversation. So at my peak, I knew 1,000 digits of pi.
Wow.
And today I've got about 100 or 150.
My
that
son
I
got
can
up to
commit.
100. He likes to memorize numbers as well.
Okay.
And he got over 100 digits of pi. And he was like 11 at the time or something. It was,
All right.
that was
Okay. Well,
kind of crazy. Yeah, nobody would guess that.
we didn't
That's
plan
cool.
that before, but that is one of my little tricks.
That's cool. That's really cool. What's next for Eastham Capital? Like as you look out, over the next 5 or
Yeah.
10 years, you
I mean,
have this build to rent space that you're excited about. Like what else
I look
are you
further
looking
out.
forward to?
So we're launching Fund VII. It's, people ask us have you made, any significant changes? Not really. I mean, our goal is to kind of stick in our lane. We know how to renovate properties. We know how to kind of manage the process of sorting through many, many deals and picking the right partners with the right deals. And I just think there's going to be a number of good opportunities coming up over the next few years. And I'm excited that there's groups that we'd like to do deals with that we've been talking to for 5 years, even 10 years, just looking for that right first deal. Once we do that first deal, we hope to do many more deals with those partners. So there's some in the mid-Atlantic, a couple of groups in the mid-Atlantic I like a lot, that it'd be great to start investing with them. And so, that's kind of what I'm looking forward to for Fund
Yeah,
VII.
fun. Well, let's wrap up with a rapid fire. That sounds good.
Alrighty.
What's one economic stat you watch obsessively right now?
10-year treasury notes,
And why is that?
because it's a big driver of what we can borrow money for our investments.
What's the biggest misconception LPs have about real estate PE?
I would say that investors, I don't think they fully understand the broad diversification you can get from investing in a fund versus doing one-off deals. And I've seen this in lots of investors, not just individuals, families, but in larger institutional investors feeling like, hey, I don't want to pay extra for the, for finding and running deals. I want to put my money just in this big deal or these deals, and I want to do one-off deals. I think that's hard work, and I think very few investors do a good job of picking deals. I think that's really what a well-run private equity real estate firm can do, is just pick the right deals to be in, and avoid, maybe the bigger issue is avoiding the deals you don't want to be in.
Yeah, I mean, I know as somebody who did real estate deals in my 20s, when I came out of Wall Street, and I did a bunch in Hawaii, a bunch of retail stuff and mixed use. I know how hard it is. And so, yeah, you definitely want to hire a professional. You don't want to do one-off deals. What's a recent deal that surprised you for better or worse?
So we bought a property in suburbs of Chicago a couple years ago, and we liked the deal. The structure worked, and we started going and renovating units. and we had a plan to renovate maybe 2 to 4 units per month. And our partner came back to us and said, the demand for the renovated units, where we can get $200 or $300 a month more for these renovated units, is far stronger than we thought it would be. And so we made the decision to basically do more renovation work, put more capital at the renovation. We didn't do that by writing a check or borrowing more money. We did that effectively through taking it out of cash flow. And my concern was that reinvesting this way would reduce our cash flow, because that's always the trade-off. If you're going to use the cash flow for renovations, it's about making an investment and kind of earning your money later on, whereas I still want to build a strong cash flow. And basically, we've been doing this now, that probably started 18 months ago, and it hasn't affected our cash flow. Matter of fact, even drawing from cash flow to make these renovations, our cash flow is growing. So sometimes things work even better than you expect. That's on the positive side. On the negative side, the world has changed coming out of COVID. And I will tell you that across the board, and a lot of my peers in the industry are seeing the same thing, there's just more bad debt and more evictions than there used to be. And that really runs the gamut of not just, moderate income workforce housing, but also up into the newer class housing. And so there's a little bit of a mentality that I've seen in America where people, maybe it's a holdover from the COVID period, where people have just felt like, hey, I don't really have to pay my rent, because somehow the government is going to take care of it. So we've been fighting that. And I think the industry has been fighting that to get people more in the mindset. I mean, this is, a large macro issue. Get people in the mindset to pay their rent.
Yeah, I mean, people are products of their environment, right? And so if you give them a nice, cushy government handout environment, they'll grow entitled and lazy. You have to create not just carrots, but sticks in our economic system to get people to kind of like, get out of their apartment and go to work.
I want to spend my whole day being a big bad capitalist, but the reality is, if you rent an apartment unit, then you're obligated to pay the rent, and if you can't pay the rent, then
it's the unfortunate reality, right? Yeah. Are there any markets that you kind of stay away from because it is just too hard to be profitable there? Any regulatory environment, like places in California, for instance?
I don't think we spoke about that before, but we've actually, if you will, redlined California. And we've done that since we started the business.
Wow. Just won't go in there.
No. There's a lot of people that have done very well in California, but it's really just not for us, given the regulatory environment and taxation, et cetera. And that's kind of bled as well to some of the other West Coast markets, specifically Oregon and Washington State.
The Social Democratic Republic of the West Coast. Yeah, I mean, you get, which is funny because that's where most of my real estate holdings are, and I'm dealing with a renovation right now on one of my single families that I still own.
Yeah,
yeah, the place was just trashed, and now I have to deal, tens of thousands of dollars of rehab because it was hard to evict the person. On the flip side, what's an underrated U.S. city for multifamily investment right now?
Good, great question. It's starting to get more notice now, but I talked about the suburbs of Chicago. We've done very well there. And broadly, the Midwest. Des Moines, Iowa is a market that we entered a couple years ago. It's doing extremely well, done very well, and we continue to invest in multiple Midwest markets. We still like Texas a lot. I think Austin and to some degree Dallas have overbuilt a bit, but people are moving there. The market trends are good. We're here in Florida. Florida continues to be a place where market demand is strong. Had to ride through some issues relating to insurance costs here in Florida. And that's starting to bleed across the country as well. Insurance has become a bigger and bigger issue across many of our markets. It'll be interesting to see what market, if we can catch another high growth market before everybody else figures out it's a high growth market. So I'll let you know when I find it.
There you go. Yeah, after you've made all the investments.
Exactly. Let me please front run that for a couple of years.
Yeah, let me front run that. What's a non-obvious trait of a great property manager?
People, the groups that understand that it's a very personal business. Multifamily is a different kind of management than office or certainly industrial. It's much more focused towards individuals and where they live 24/7. I mean, I guess to some degree that's true in hotels, but you have service levels important, not as important as it is in hotels, but it's still very important. And so I think the best property managers have a high level of personal service for their residents.
What's a favorite book you've gifted or recommended in the last year?
There's a book, it's sitting on my nightstand, and I'm forgetting the name of it, but it has to do with kind of the changes in America's relationship with China.
All good, all good. That sounds interesting. Is it the Ray Dalio one?
It's
Where
not Ray Dalio.
yeah, he has a couple out there. Yeah.
Yeah.
What's an emerging risk that you think most investors are still underpricing?
As much as I believe in the whole artificial intelligence movement and kind of what's going on there, and I think there are some huge winners and will continue to be huge winners, I still have doubts about the quality of the data in the databases. I think there's a risk that, there's a lot that can get done with these, large language models and with these databases, but I feel that there's always a risk that there's a lot of crap in databases that, could push people to make decisions that aren't the correct ones. And I see this in my own business. And I was talking to, got a couple of analysts there in their, in their mid-20s, relatively recent college grads, and I'm asking them, how much are we using AI to underwrite our deals? And while we're using it a little bit, their biggest concern is that the data that they're getting is not as, they really have to kind of scrub the data to make sure that they're getting accurate data to help us.
Yeah, I can relate to this. I mean, in due diligence on startups, I mean, I'll plug it into AI and they'll be like, you should invest. And I'm like, well, let's take a look at each of these numbers real quick. This traction's actually not correct. That revenue is not correct. So now rescore it with that traction. Okay, now you shouldn't invest.
Okay.
So yeah, you have to be really careful. You have to double check you have to scrub all those data points and just fact check it and verify each point, and use your human intuition. Like that doesn't feel right, and then dig in. AI could be a really great assistant for helping you move quicker, but you have to still verify everything.
Exactly.
Last question: if you had to launch a business outside of real estate, what space would it be in?
I don't think it's necessarily a good financial business, but I'm always been very interested in sake. And I think that possibly, I think there's not a lot. I mean, certainly people drink sake, especially on the West Coast, but I think there's some opportunities to bring sake more across America to the East Coast.
Silverman sake. Just do it. I mean, you have the alliteration in the name right there. I love alliteration. So like I would do the Brian Bell bourbon probably.
There you go.
It's been a great conversation. Where can folks find you online?
Sure. So Eastham Capital, it's EASTHAMCAPITAL.com is our website. And please visit our website. My email address is Eric, ERIC, at easthamcapital.com. Please feel free to reach out to me directly. And we are on LinkedIn. A lot of people find us through LinkedIn. So come check us out on LinkedIn as well.
Well, yeah, thanks for so much for coming on.
Okay. Thanks so much, Brian. Appreciate it.